Hi there, good morning, and compliments of the season. My name is Victor Alui. I'm the head of investments at Sankore Global Investments. I mean, we're pretty much into the Christmas flow. This time next week, it will be Christmas. And we've also seen, strong moves in the market. Again, just to get right into it, we just provide this quick update on, what happened in the market last week and what we are likely to see, going into the new year. I mean, last week was a very strong week. We essentially saw the rally of everything. We started the week off with, U.S. inflation, which basically continued to slow. It came in at 3.1%, slightly lower than the previous 3.2% reading we had seen. We also saw producer price inflation also continue to slow as well. And then the next day we had, the Fed meeting where, the Fed did not only just hold rates steady, but really, gave the markets what I'll call a Christmas gift, indicating that they were going to cut rates at least 3 times next year. What that basically did was to reaffirm the fact that they were done hiking, but more importantly, also open the door to, a dovish move going into next year with a possible 3 hikes next year. And what that did was to, basically just open up the markets. Investor sentiment turned strongly bullish, after that meeting, and essentially continued, through the week. The Dow Jones gained about 2.9%, S&P was up 2.5%, the Nasdaq gained about 2.85%. U.S. Treasuries also rallied, shed about 34 basis points, last week, dropping from about 4.3 to close the week at about 3.9. So again, we just saw a rally across all risk assets as, the Fed essentially guided to the fact that, it was going to cut about 3 times, next year. However, in Europe, the story was a bit different. The ECB had its meeting where basically, talked about the fact that, essentially struck a more cautious note, talked about the fact that, it's still watching out for inflation and trying to see how things pan out. Didn't guide to any rate cuts, but, again, we are likely to see them, to the path of the Fed going into 2024. So last week was a really strong week for the market. Also, if you look at the mortgage space, the rate on the 30-year fixed mortgage dropped below 7% for the first time in a very long time. So clearly, the Fed has fed a lot of positive sentiment into the market, and essentially we have a Santa rally on as it is. However, going into this week, we think that there would be some slowdown from all of the exuberance that we saw last week. Nevertheless, we think that the positive sentiment would definitely remain. So again, we think that this year is going to close out, on a very strong note. And if you dimension the U.S. market, we've seen, what have been described as the Fantastic Seven really drive most of the rally that we have seen in the U.S. market, accounting for about 70% of the rally that we've seen. So stocks like Microsoft, Apple, Amazon, Nvidia, and co, Tesla as well, have done very strongly. They've been termed the Fantastic Seven. They've done very strongly this year, and continue to do so on the back of, the Fed's, latest rhetoric around, a really strong dovish pivot, going into next year. If you then dial things back locally, just looking at what happened locally, it was also a very busy week locally as well. We got inflation last week at 28.2%, a new high as well. That inflation number continues to rise, in a continued reflection of, the removal of subsidy and also a continued rise in food inflation. We believe that number is likely going to be higher for next month, for December. Particularly because, again, the festive period spending is going to kick in. So all of that is going to be very strong in the next reading that we see. Whether or not the central bank decides to tighten further at its policy meeting really remains to be seen. Also, we had a primary market auction last week where, the DMO planned to sell about 15 billion worth of bills, but ended up selling significantly more. Got subscriptions in excess of 1.5 trillion, and stock rates closed lower across board. The 90-day closed at 9%. It dropped about 275 basis points. The 180-day closed at 13%. It was down 200 basis points, while the 1 year closed at 15.75. It was down 225 basis points. And this Sentiment was also reflected in the secondary market as yields dropped quite significantly for the one-year treasury bills, basically looking at handles around the high 14s and going into 13s as well. For the FGN bond, again, the government wanted to sell, that's DMO, and I wanted to sell about 360 billion across various maturities, but ended up selling significantly more. Got subscriptions of about 884 billion. Stop rates closed lower across board. At the very short end, 2029, closed about 15.5%. That was 50 basis points lower. The 2033s closed at about 16%, which was 100 basis points lower. At the middle of the curve, it closed at about 16.5%, which was 100 basis points lower as well. While the 2053, which is the long end, closed at 17.15%, which was 75 basis points lower than the previous close. So again, we're seeing yields, drop, in the aftermath of these auction outcomes. Really remains to be seen how the rest of the year pounds out. We think that all of that liquidity that was, went into the market, those bids that were on field, will basically filter through into the secondary market and serve to continue to drag yields even further, downwards. So going into the rest of the year, really, we expect the market to maintain that sort of momentum. We also expect, equities in the US to remain strong, albeit with some profit taking intermittently. So we think that this is how the remainder of the year really is likely to play out. We hope that you do have a productive, rest of the year, and we do wish you a really Merry Christmas and a Happy New Year in advance. Thank you very much.